Most people do not recognize a once-in-a-lifetime opportunity when it arrives, because it almost never looks like an opportunity at first. It looks boring. It looks uncomfortable. It looks like waiting while everyone else is bragging. It looks like holding cash when your neighbor is making money in stocks, watching prices climb higher, and feeling like the train has already left the station without you. And that is exactly why Warren Buffett's quiet warning matters so much. Right now, not because he is telling you to panic, not because he is telling you the world is ending. Buffett has lived through wars, inflation, recessions, crashes, bubbles, banking failures, political chaos, and market manias, and his message has almost never been panic. His message has been discipline. But when Berkshire Hathaway is sitting on mountains of cash, when stocks have been pushed to levels where future returns may already be squeezed, and when ordinary investors are being trained to believe that every dip must be bought immediately, Buffett's behavior says something louder than any headline. He is not rushing. He is not chasing. He is not pretending that every price is a good price just because the crowd is excited. And that is the warning. The opportunity may not be the thing everyone is buying today. The opportunity may be the rare chance to prepare before other people are forced to react. Imagine a man named Robert, 58 years old, standing in his kitchen early in the morning with coffee in one hand and his phone in the other. His retirement account is near an all-time high. His friends are talking about AI stocks, crypto, tech funds, and how cash is trash again. Every financial app is showing green arrows. Every headline sounds confident. And Robert feels that familiar pressure in his chest, the pressure that says, if I do not put more money in now, I am going to miss it forever. So he thinks about moving his emergency fund into the market. He thinks about buying whatever has gone up the most. He thinks about taking more risk, not because his plan changed, but because prices changed. And this is where Buffett would probably stop him before he makes the mistake that destroys more wealth than any recession ever could. The mistake is not buying stocks. Buffett loves productive assets. The mistake is forgetting the difference between a good business and a good business and a good price. The mistake is assuming that because an asset has made money recently, it must still be safe. The mistake is believing that opportunity only exists when everyone else can already see it. Buffett built his fortune by doing almost the opposite. He waited, he studied, he let other people become emotional first. Then, when fear returned, when forced sellers appeared, when prices finally made sense, he had the one thing everyone suddenly wished they had: liquidity. Cash is mocked during bull markets because it feels lazy. It just sits there. It does not post exciting gains. It does not make you feel smart at dinner. It does not give you a story to tell. But cash has a hidden power that only appears when conditions change. Cash is not just money. Cash is the ability to say no. Cash is the ability to survive a layoff without selling investments at the worst possible time. Cash is the ability to buy when others are selling. Cash is the ability to wait until the math is in your favor. Buffett has often treated cash not as a failure to invest, but as ammunition. And that is the part most everyday investors misunderstand. They think being fully invested means being brave. Sometimes it does. But sometimes being fully invested at any price simply means you have no choices left. When everything is expensive, patience feels like doing nothing. But in reality, patience is an active decision. It is a position. It is a refusal to turn your future into a bet just because everyone around you is impatient. The opportunity Buffett is pointing toward is not necessarily one stock, one sector, or one magic prediction. It is the opportunity to become the kind of investor who is ready when the easy money disappears. Because history does not reward the person who is excited at the top. History rewards the person who still has a plan after the excitement fades. Think about what happens in every market. Cycle. At first, prices rise because businesses are improving. Then prices rise because earnings are growing. Then prices rise because people believe the future is bright. But eventually, prices start rising simply because prices have been rising. That final stage feels amazing while it lasts. It creates the illusion that risk has disappeared. People who have never studied a balance sheet suddenly feel like geniuses. Cash feels stupid. Caution feels old-fashioned. Valuation feels irrelevant. And then something changes. Maybe interest rates stay higher than expected. Maybe inflation refuses to die. Maybe earnings disappoint. Maybe a sector that everyone believed was unstoppable stops. Maybe nothing dramatic happens at all, and returns simply become disappointing for years because too much optimism was already baked into the price. That is the part nobody wants to hear. A market does not have to crash tomorrow to punish overpayment. Sometimes the punishment is slower. You buy at a heroic price, then spend years waiting for reality to catch up to expectations. That kind of loss is quieter than a crash, but for retirement investors, it can be just as painful. Because time is not unlimited. If you are 35, you can recover from many mistakes. If you are 60, 65, or 70, paying too much for the illusion of safety can steal years you cannot easily replace. This is why Buffett's warning matters more for regular people than for Wall Street professionals. A hedge fund manager can make a bad call and still collect fees. A financial influencer can delete a video. A trader can move on to the next hot idea. But your retirement account is not content. Your savings are not a game. Your future income depends on what you do when everyone else is emotional. And right now, many investors are being emotionally trained in the wrong direction. They are being told that waiting is weakness. They are being told that cash is dead. They are being told that valuation no longer matters because technology changed everything. But we have heard versions of that sentence before. We heard it in the late 1990s. We heard it before the housing crash. We heard it in every period when the crowd found a reason to explain why old rules no longer applied. And Buffett's genius has never been that he predicts the exact day the party ends. His genius is that he refuses to need the exact day. That is a powerful distinction. You do not need to know when the market will fall to know that overpaying reduces future returns. You do not need to know which company will disappoint to know that not every popular stock is a bargain. You do not need to predict the next recession to know that having an emergency fund matters. The average person thinks investing is about prediction. Buffett's life suggests investing is more about preparation. Prediction says, I know what happens next. Preparation says, I do not need to know what happens next because I am built to survive several outcomes. That is the mindset shift that changes everything. Robert, the man in the kitchen, does not need to sell everything and hide under the bed. That would not be Buffett-like either. Buffett has always believed in owning great businesses over time. But Robert does need to stop confusing market excitement with personal readiness. He needs to ask harder questions. If my portfolio fell 30%, would I be forced to sell? If I lost my job, would I need to raid my investments? If stocks went nowhere for 5 years, would my plan still work? Am I buying because the price makes sense, or because I am afraid of being left behind? These questions are uncomfortable because they remove the fantasy. They turn investing from entertainment back into responsibility. And responsibility is not as exciting as a hot stock tip, but it is how wealth is actually protected. One of Buffett's most underrated lessons is that risk is not the same thing as volatility. Volatility is the price moving around. Risk is permanent loss of capital. Risk is needing money at the wrong time. Risk is buying something you do not understand with money you cannot afford to lose. Risk is building a retirement plan that only works if everything stays perfect. And perfect conditions are temporary. People forget this during good times. They take a rising market and mistake it for personal skill. They take easy credit and mistake it for safety. They take paper gains and mentally spend them before the money is real. Buffett's entire career is a reminder that the market is not there to validate your emotions. The market is there to offer prices. Sometimes those prices are attractive. Sometimes they are ridiculous. Your job is not to participate in every offer. Your job is to recognize the few offers that actually make sense for your life. That is why the phrase, "an opportunity like this won't come again," can be misunderstood. It does not mean you should rush into whatever is trending today. It may mean the opposite. It may mean that the opportunity to build discipline before the next storm is rare, because during the storm, discipline becomes expensive. During good times, you can raise cash calmly. You can reduce bad debt calmly. You can rebalance calmly. You can build a watch list calmly. You can learn calmly. But when panic arrives, people are not calm. They are selling to cover expenses. They are checking their accounts at 2 a.m. They are making decisions from fear. Preparation must happen before. It is needed. That is the opportunity. Not a secret stock. Not a magic date. Not a prediction. The opportunity is to use today's comfort to become stronger before tomorrow's discomfort exposes who is only pretending. Buffett's cash position also teaches another lesson that ordinary investors rarely appreciate. You do not have to swing at every pitch. In baseball, if you let a good pitch pass, it counts against you. In investing, there is no penalty for waiting. You can watch hundreds of stocks, hundreds of funds, hundreds of opportunities, and do nothing until the math is attractive. The problem is that modern investing apps are designed to make doing nothing feel almost impossible. They show charts every second. They send alerts. They gamify your attention. They make patience feel like inactivity. But Buffett comes from a different school. He acts as if every dollar is an employee that should only be hired when the job is worth it. If the job is bad, he does not hire the dollar. He lets it wait. That sounds simple, but it is emotionally difficult, because your ego wants action. Your fear wants action. Your envy wants action. But your future often benefits from restraint. This is especially true when prices are high and expectations are even higher. If you buy a wonderful company at a fair price, time can work for you. If you buy a wonderful company at a fantasy price, time first has to repair your mistake. That is a huge difference. Many people say, "I am a long-term investor," but what they really mean is, "I hope time forgives any price I pay." Sometimes it does. Sometimes it does not. Buffett's warning is that price still matters. Not because you should become obsessed with timing every move, but because your future return is heavily shaped by the price you accept today. A house can be beautiful and still be overpriced. A company can be excellent and still be a poor investment at the wrong valuation. A market can be full of innovation and still be too expensive. Two things can be true at once. America can remain productive, and stocks can still be priced for disappointing returns. Technology can change the world, and investors can still overpay for the story. Buffett understands that distinction. Beginners often do not. They hear great company and translate it into great stock at any price. That is how smart people lose money in obvious ways. The real opportunity now is to separate quality from hype, patience from fear, and investing from chasing. So what should a normal person actually do with this warning? First, stop treating your emergency fund like wasted money. A proper cash cushion is not there to beat the market. It is there to protect your investments from your life. That is its job. Second, look at your debt. If you are paying high interest, credit card debt while trying to chase market returns, you may be stepping over a guaranteed problem to reach for an uncertain solution. Buffett would not admire complexity for its own sake. He would likely admire simple math. Third, review your allocation. If your portfolio only feels comfortable because the market has been going up, it may be too aggressive. A portfolio should be designed for your actual temperament, not your imaginary bravery during a bull market. Fourth, build a list of assets you would love to own at better prices. Most people only start looking for bargains after prices fall, when fear clouds their thinking. Do the work before the sale. Know what quality looks like. Know what balance sheet strength looks like. Know what reasonable valuation looks like. Fifth, commit to a process instead of a prediction. Dollar cost averaging into diversified funds can still make sense for long-term investors, but that does not mean you ignore valuation, liquidity, or personal risk. It means you combine consistency with common sense. You do not need to become Warren Buffett. You need to stop behaving like the crowd he has spent a lifetime taking advantage of. There is a huge difference. The crowd wants certainty. Buffett accepts uncertainty and demands a margin of safety. The crowd wants action. Buffett waits for advantage. The crowd wants to feel rich quickly. Buffett is willing to look boring for years if that is what the math requires. And maybe that is the hardest lesson of all. Wealth often looks boring before it looks impressive. It looks like not buying the car, not upgrading the house too soon, not chasing the stock after it already tripled, not selling in panic, not confusing. A bull market with genius. Not letting social pressure rewrite your plan. Then one day, when everyone else is trapped by decisions they made during the exciting years, the boring person suddenly has choices. That is when boring becomes powerful. Robert, standing in that kitchen, does not need a secret. He needs a reset. He needs to understand that the biggest opportunity may not be the market giving him easy money. The biggest opportunity may be the market giving him time to prepare, time to build cash, time to reduce fragility, time to study, time to become patient before patience is demanded from him. Because when the next real opportunity appears, it probably will not arrive with a clean label. It will arrive in fear. It will arrive when headlines are ugly. It will arrive when your friends no longer want to talk about investing. It will arrive when people who mocked cash suddenly wish they had some. And that is why Buffett's quiet. Warning is so valuable. He is not teaching you to predict the storm. He is teaching you to build the kind of financial house that does not collapse when the storm comes. The opportunity like this that may not come again is not just a price on a screen. It is the chance to become disciplined while discipline is still optional. Because later, when markets are chaotic, discipline will not feel optional. It will feel like survival. And the investors who prepared will not need to be fearless. They will simply need to be ready.